Gilti was created under the Tax Cuts and Jobs Act. And as we've seen with the transition tax, when they rush through a new tax law, sometimes things don't always work out perfect, and Gilti is no exception to that. So, Gilti is the Global Intangible Low Taxed Income. So, what it seeks to do is test global intangible income that's from low tax jurisdictions, just like its name says. So, basically, what they're saying is if you hold an intangible asset and it's earning money abroad, there's no reason you couldn't hold that intangible asset here in the US because it's intangible. There's no physical place that it has to be. So they're not going to let you benefit by holding that in a low tax jurisdiction and taking advantage of those tax rates, which on its, in theory makes perfect sense. However, the application, there's some issues with it. So first of all, it applies to CFCs, controlled foreign corporations. If you file a Form 5471, this would be the Category 5 on that form. And what it looks at, it's a very detailed calculation, but to give you a high level, it basically takes the income of that corporation that's not being taxed currently in the US, and it gives you a set aside for a 10% return on those depreciated assets of that entity. So you take the assets, there's depreciation methods you have to go through, you come up with your depreciable asset base, and you get a 10% amount from that they say is actually made off those assets. Everything else is deemed to be intangible. Now, there's a couple problems with that, as you can see right away. The first one is there's nowhere in this definition where actual intangible income comes into play. It's, in theory, should be okay to try to determine the actual intangible income. There's other places in the code, other places under subpart F income, where we actually look at intangible income, royalties, and licensing. So it doesn't really make sense why we have this formula to determine Gilti, and nowhere in the formula does it actually have intangible income. The other problem is, since we're looking at a depreciable asset base, what about service companies or companies that don't have any hard assets? They may have nothing to do with intangible income, but because they don't have an asset base to earn their income, it's all automatically deemed to be intangible income. Or what if you're an older company, even if you're doing manufacturing, which is the exact opposite of intangible income? If all of your assets are older and are fully depreciated, you don't have a depreciable base, therefore all of your income is going to be deemed to be intangible. Lastly, what about successful companies? What if you have a 50% return on your assets? For some reason, they just have this 10% return that's all you're allowed to get. So if you're successful for your assets, you're almost penalized to a certain degree because they deem the rest of it to be intangible. Now, on top of all this, if you're properly filing your Form 5471, they would have all the information at the IRS to try to assess Gilti against you, which means you can't just ignore this. You're actually going to have to file the forms. And no one knows for sure yet if those forms aren't filed. Maybe your 5471 is substantially incomplete, which could cause all sorts of problems with statute of limitations and other penalties. And if you haven't been filing your 5471, now is a good time to get caught up through the Streamline program or other options. But it's just one more hurdle you have to do and one more thing you have to calculate to get there. Now, there are some mitigation techniques for individuals that own these foreign corporations in terms of making a 962 election, which is very detailed, but it allows you to be taxed as a corporation, and therefore you can get benefits for the taxes paid in the country, and there's another deduction you're allowed to get. But overall, this is a problem for everybody, because whether you're a corporation, an individual, or an individual making that election, you're going to have to potentially address something to tax global intangible low taxed income, even if you don't have any low taxed income, even if you don't have any intangible income. Because even if this is zero, you still have to fill out all the reports and do all the filing. And at the end of the day, you may end up paying tax, even though you have zero intangible income, just because of how this formula is set up to not actually have any intangible income in there. Really, from the takeaway from Gilti is there's no way to understand exactly how your numbers are going to work out. The most important thing to take away is that it is real. It does apply to all CFCs. These forms are there and do have to be completed. So it's something that we cannot ignore. We hope that in the future the IRS will put de minimis rules in or something so that not everybody has to go through all this. But until that time, it's something you need to address and you need to give some thought to.